Hello and welcome. India's economy, like it or not, is at crisis point. We are at our lowest point in at least the last 20 years. What happened to that great Indian dream of just 2 years ago? Have we moved from a breakout nation to a breakdown nation in just a few months? With due respect to Ruchir's book and his phraseology. The rupee has collapsed, the stock market is falling, industrial output is stagnant or in decline, unemployment therefore is rising, and the escape from poverty will now take much longer like this. So the question is this just a temporary cyclical problem, or are we going to face a long-term crisis? Ruchir Sharma, the author of the hugely successful book The Breakout Nations, and Arun Shourie are both with me to try and understand in a non-partisan way what exactly is broken in our economy, why it all went wrong, and who is to blame. We should also try and look at what should each one of us do now to protect our savings, our income. But first, how bad is it really? As we shall see in a few minutes with some of Ruchir and the Morgan Stanley graphs, things are really bad. If we carry on like this, India will be declared junk status. This junk status rating could even happen, some say, in less than a year from now. There is even a possibility that India will have to go back to the IMF. Remember, India today has $170 billion in short-term loans to repay by March next year. $170 billion is a mammoth short-term debt. Can we repay that without a loan from the IMF? Any loan from the IMF, of course, comes with all its tough conditions. In this program, we'll also look at what has caused this problem. How much of this crisis is global and how much is local? Now, there's little doubt that the immediate reason behind the money flowing out of India to America is that the US economy is doing much better and investors are flooding back there. The tide of money is flowing from all emerging markets, developing countries, back to America. Everything was sort of fine as long as America was doing badly. Money flowed to India and other emerging markets, other developing countries. We were all swimming along on the incoming tide of dollars. But there is a saying, when the tide runs out, only then do you know who was swimming naked. Well, the tide has run out, and India, I'm afraid, has been caught with its pants down, so to speak. Now, there's nowhere to hide anymore. With the ebb and flow of the tide of dollars, many see a parallel rise and fall of India's economy. Let's have a look at some key factors. But first, Ruchir, before I go into the data, how bad is this really?
Well, as you said, this is the lowest that we have had in terms of confidence since 1991. I don't think that we are quite there yet. This is not like 1991 on many metrics that you evaluate, but the pain of having tasted the success of growth last decade, that sensation of rapid and rising prosperity that we tasted last decade, the fact that that's being taken away is, I think, feeling even worse to some people than what it felt in 1991. So in economic terms, though, if you look at it, this really is the worst that we've been since then, although we are not quite there.
Sentiment you're saying is terrible. Like you go all over the world, even in India, there's pessimism, gloom about the Indian economy.
Exactly. And in fact, like internationally, I would say that even before the events of the last few weeks, as they say, the opposite of love is not hate, but indifference. And I think that's what was going on, that people were, sort of had given up on India, were not really speaking much about it. But now, of course, with the crisis looming ahead of us, people are speaking much more about India in a negative way. So I think this has been the huge transition in sentiment that's taken place over the last couple of years.
Arun, do the people of India, the Congress party, opposition party, realize what a crisis we're in, or are we kind of swimming along thinking everything is not too bad?
I think that the political class doesn't realize at all. They are just concerned with the breaking news of this shift.
Right.
And media has given them that, sort of habituated to them in that way, and they don't see that it's not that we are heading into a crisis, we are
in
in
the
a
middle of
crisis.
one, yes.
And Ruchir says that people started being indifferent, not in the last few weeks or few months, but over the last 2 years. Over the
They've
last 2
seen a
years, in
slide.
every single investor conference, Prannoy, that I went to, Japan, Hong Kong, anywhere else, people said, "Arey bhaiya, we'll look at India when you people get your act together.
Yeah.
We have other things to do." And it is now quite wrong to think that all that has happened is that the US economy is rising and the people are taking their money there. They are actively pulling their money out because of a vote of no confidence in
In the
India.
Indian, right. These are exactly the issues we want to look at. Let's have a look at what has actually happened. Let's have a look at the dollar and the rupee exchange rate, and see how the rupee has plummeted. And it's really happened in the last 3 months since May. These are some figures put together by Ruchir. You can see from the beginning of that graph is about 2007. It's more or less flat, and then since May, the sharp decline. How low will it go? Ruchir, this decline we've seen just seems to get worse and worse every day.
Well, I think this is the issue with currency panics, that once they start, you really don't know as to where they will stop. Because on any valuation metric, it appears that the rupee now is somewhat undervalued and definitely not overvalued like it used to be a couple of years ago.
Right.
But the issue with currency panics is that you never know as to when they will stop, or how much you have to undershoot the fair equilibrium before you get some sort of reset of confidence.
Right. Let's just have a look at one of the reasons that your data shows,
Right.
and your team's data shows on why the rupee has fallen. Let's have a look at the outflow of money from India in the last 3 months. This is what it looks like. If we move on to the next graphic, you'll find how low will it go. That's the rupee. Now this is the FII equity. It had gone up this year by $14 billion, and it just came down since May by $2 billion. But what about FII debt? Let's have a look at that. It went up by $6 billion this year, and it's gone down since May by $10 billion. So we have seen $12 billion going away from India since May, and that $10 billion debt has gone to debt in America. So Ruchir, $12 billion in a matter of 3 months, tough for any country to take that.
That's right. And this is just one component of it. This is just portfolio investors pulling money out. There are other components of your balance of payments where a lot of money is getting pulled out, and then you have people like exporters, importers. When they get into a panic mode, the exporters tend to keep more of the dollars abroad. The importers want to hedge even more than what they are supposed to hedge. So you get like a domino effect which builds in. So this is just a snapshot of what's happening to your balance of payments. The complete picture
I
looks
just
even
want
worse.
to clarify one thing. May we find is a turning point. That is when America announced quantitative easing is not going to be, or they're not going to do so much quantitative easing. I don't know what the term is.
Well, the
They're
term is
relaxing.
tapering. The term is tapering, which they
Tapering,
say.
right,
Tapering the
yeah.
quantitative easing.
Yeah.
But really, so that was the tipping point, which is
And then
that,
interest rates in America went up.
yes, long-term interest rates went up very sharply
So
in America.
bonds from here went. People who are investing bonds in India found that more attractive.
Yes,
And
this
out it went.
Yeah, this sort of yield bubble that we had across the world burst, and we saw this sort of simultaneous move out of money since then. But that's the proximate cause in terms of
I want
what's
to
happened
actually
here.
get to Arun. Just see the next graphic, which
But
Richard
if I may
also
just
pointed
mention
out.
one small
Yeah,
point
sure.
on this. You see, I feel that this rupee business is a symptom.
Yes.
It's not the problem.
Yeah.
And
We're actually going to
second-
come to exactly.
Yes,
This is
but
just now
Prannoy,
what the
just,
symptoms are.
but,
Yeah.
just on one
You're
point,
dead right, actually.
You see, actually speaking, the real problem was that India was taken for a ride in its psychology
Yeah.
Yes.
by not seeing that we have become dependent on short-term flows.
Exactly.
I mean, Morgan Stanley and everybody else's data showed that in other countries, when they were booming, in Brazil, for instance, FDI was 80% and FII was 20%.
Right.
Here, it was the opposite.
Yes, but unfortunately,
naturally-
Brazil is also in deep trouble, as we'll see.
Right, we'll see.
I just wanted to bring up a point about India not being attractive. We move on to the next graphic. It's really startling, exactly what Arun is talking about. FDI, foreign direct investment. Just look at what's happened. 2008, foreign direct investment was 48 billion. 2013, it should be growing because our GDP is growing. It's 27, almost half of what it was. So Ruchir, this is, as Arun says, this is actually lack of confidence in India, not comparable with America. This is just India's story going bad.
And
yes, that's true. That in terms of what's happened in the last couple of months is something which has been caused by global factors. But the fact of the matter is that why did we become so exposed to foreign capital and so dependent, as Arun says, on short-term foreign capital? Because if you look at even outside of FDI, the foreign ownership of the Indian stock market today is above 20%, the highest that it's ever been in the history of the Indian stock market.
My
And there are more than $200 billion of portfolio flows in the Indian equity market.
Right.
And I think that what we've seen just now is that they have not been the swing factor, that they've taken just 2 billion out of the more than 200
Equity,
billion.
the FII equity was just 2 billion.
Yes, and they
It's
have
the
more than
debt.
200 billion,
Yes.
but in debt we've seen a big swing, and there are other components of the balance of payments where the data is not available to us that easily, where you will see an even bigger swing in terms of the outflows which are taking place.